How would you like to pay your mortgage off early at your current income level? Meaning you're going to take years off your mortgage and save thousands of dollars in interest, and you don't have to make any more money than you're currently making now. I'm going to show you how to do that. This is Monday Mornings with Mark. Hi, I'm your host, Mark J. Schmidt of RE/MAX Country and MoveMeMark.com, where I help you get the most out of the real estate market and your home. If you're new here, be sure to subscribe to our channel on YouTube and make sure you like us on Facebook so you don't miss out. You know, buying a home is one of the most exciting things you can do. It's just fantastic having your own place that you can call home that's yours. The second most awesome thing you can do is paying that home off when you no longer have a mortgage and you no longer have to send a payment to anyone every month. Well, today I'm going to share 5 things with you that you can do that are going to help you do just that, and you're not going to have to make any more money than you're currently making now. Now, before we get started, I want to let you know there are some loans out there and some lenders that you won't be able to pay your mortgage off early. You'll actually have penalties for paying your mortgage off sooner than you're supposed to. Now, there are not a lot of loans like that out there, but you definitely want to check with your lender and make sure that you won't incur any penalties for paying your loan off early. So with that being said, let's get started. My first tip for you is trim the fat. What are you spending money on that you really don't need to be spending money on? For example, do you go out for coffee every day? Do you go out to lunch a lot? Are there things that you're spending money on that you really don't need to be spending money on? You see, if you just, for example, make your own coffee at home, if you brown bag your lunch and bring that into work instead of buying lunch, that money that you're spending on those things, you take that money, you put them towards your mortgage, you can actually save a lot of money on your mortgage doing that. It's actually really surprising. I'm going to share some numbers with you in a little while that are going to show you how even just $20 a month extra on your mortgage are going to make it possible for you to save thousands of dollars over the course of your mortgage. So that's the first thing, trim the fat. The second idea I have for you is make your mortgage payments bi-weekly instead of monthly. So what does that mean? Usually you're probably just making one mortgage payment a month. Instead of making one mortgage payment a month, cut your mortgage payment in half and send that in every 2 weeks. Now, how does that actually pay your mortgage off early? Well, it actually causes you to make one extra payment. You see, when you're paying once a month, you make 12 payments a year. When you pay every 2 weeks, or make half a payment every 2 weeks, you're actually making 13 full payments by the end of the year. This is going to save you thousands of dollars. Now, a word of caution. There are lenders out there. Now, I actually got a letter like this years ago. They'll try to get you into their program to do that. I got a letter years ago from my lender that said, hey, Mark, we got this special program. It'll help you pay down your mortgage sooner. And it's $300 to get into this program. And we're going to automatically deduct half of a payment from your checking account every 2 weeks, and we're going to charge you $6 every time we take the money from your account. And I was like, gee, that sounds great. I mean, paying $300 and then $6 extra every time they take a payment, but I passed, and you should pass too. This is something you can do on your own. You don't need to get involved in a program like that. Just make half a payment every 2 weeks. It's the same exact thing, and you're not paying any junk fees. The third way you can save money and years on your mortgage is by refinancing. So right now, interest rates are super low. If you find that your current interest rate on your mortgage is 1% higher than prevailing rates, you really should consider refinancing. This can save you thousands of dollars in interest payments alone. Now, on top of that, you don't have to refinance into another 30-year loan. You can drop down to a 15-year loan. That's obviously going to make your loan period a lot shorter. And if you want to, you can even make extra payments on top of that. But dropping down to a 15 is obviously a great way to save a lot of time and a lot of interest on your mortgage. Now, you might say, gee, I don't know. I'm comfortable with a 30-year mortgage. a 15-year mortgage, I'd hate to be locked into that higher payment. Well, how about this? Either refinance into another 30-year mortgage if you need to, if your interest rate is high enough currently that it makes sense, or just remain with your current 30-year mortgage, but make your payment like it's a 15-year mortgage. You can use a mortgage calculator online, and you can just put in your numbers, how much your mortgage is, like how much your principal is remaining, and it will tell you what you should be paying if it were a 15-year mortgage. Make that payment instead of paying it like the 30-year mortgage that you have. Now, what this does is it pays your mortgage down early, and at the same time, if you need some flexibility, if you're concerned because maybe an unexpected expense has popped up, well, then you don't have to make that 15-year payment. You just make the regular payment without the extra. So it does give you a little bit of flexibility. That, I think, is a fantastic way to save a lot of time and money on your mortgage, but still give you the peace of mind that you might like. Number 4 is to get rid of your PMI. What's PMI? PMI is private mortgage insurance. Anytime you buy a home and you put less than 20% down on the home, you're going to be paying PMI. PMI actually insures the lender. Should you default on your loan, it will make up the difference between what you put down and that 20%. So there are 2 ways that you can get rid of PMI. You can either pay enough mortgage payments that your balance, what you owe, you hit that, what they like to see is the 78% mark, okay? So as long as you've paid off enough of your mortgage that now you've got that 20 to 22%, they will take the PMI off for you. Now, there's another way you can do it, and this is actually pretty exciting. You don't have to actually physically pay off the mortgage to that level. As long as your home has appreciated in value enough, you can get the PMI taken off. Now, most mortgage insurers, they want to see that you've been in the house for at least 2 years in order to do that. So if you've only been in the house for 6 months or a year, it's probably not going to work going the appreciation route. But if you've been in 2 years and maybe you're close to paying it down to that level and you can use appreciation on top of that, you should definitely look into it. Once you get the PMI taken off, don't just save that money. Keep making your mortgage payment with that extra amount on it because frankly, you've already been paying it. You're not going to feel it, and PMI can wind up being $100 to $150 a month. Just keep it there and you'll be able to pay your mortgage off that much quicker. Now, one thing to note, if you've got an FHA loan, you won't be able to take your PMI off. It used to be that FHA loans could have their PMI removed, but they changed that rule in the last few years and you won't be able to take it off. The only way you can get PMI off with an FHA loan is actually to refinance. So you might want to think about that if you know you've got enough equity in the house to get rid of PMI. Now, my 5th way that you can save on your mortgage is, now this one's pretty extreme, but you can downsize. Listen, if you've got a big house and you've got a large mortgage payment and you don't need all that house, downsizing, selling your home, getting into a smaller home with a smaller mortgage is a great way that you can be debt-free sooner. You know, if you're able to pay this higher mortgage payment for the bigger house, you'll obviously easily be able to make that same mortgage payment on a smaller house with a smaller mortgage. But you'll be able to pay it off sooner because you're already used to making that higher mortgage payment. Just make that higher mortgage payment for the smaller house. So downsizing is a great way to go. So let's look at some numbers so you can get a better idea of how much you can save by really not having to spend a lot more money on your mortgage. I wrote down some figures here. These are all based on a loan amount of $250,000 with a 30-year mortgage at 3% interest rate. The monthly mortgage payment for a loan like that would be $1,054 a month. Now, if you pay just $20 extra a month towards your mortgage on a loan like that, now remember I talked about how not getting coffee, not buying lunch, you can find $20 there really easily. If you do that, this will take 10 months of mortgage payments off your mortgage, and you're going to save $4,313 in interest. So that's great. I mean, that's over $10,000 in mortgage payments and over $4,300 in interest just by sending $20 extra a month. Now, what if you decided, you know what, I'd like to make an extra mortgage payment. I'll take my mortgage payment and I'll divide it by 12, and I'll just add that amount. So remember, you don't have to take your full mortgage payment. You just have to take the principal and interest portion of your mortgage payment, divide that by 12, and add it to your monthly mortgage payment. So if you do that on a $1,054 a month mortgage, that would be an extra $87.83 a month. That is going to take 3.5 years off your mortgage and $16,953 in interest off. Just think about that. You're saving almost $17,000 in interest. That's awesome. And that's just by spending another $87.83 a month. Now, what if you combine the two? What if you said, you know what, I'm going to make that $87.83 plus I'm going to put another $20. I'll stop going out for coffee and things like that. That takes 4 years and 2 months off of your mortgage, and you're going to save $20,190 in interest. That is amazing. That's not a huge sacrifice to just add another $107.83 a month to your mortgage. And remember, if you do have a time when money's a little tight, you don't have to send it. But taking that route and just sending that money, you're going to save tens of thousands of dollars. Now, remember when I said you could pay your 30-year mortgage like a 15-year mortgage? This would take your payment from $1,054 to $1,726 a month. Now, that's a sizable increase, but if you can swing it, it's going to take 14 years and 11 months off of your mortgage, and you're going to save $68,660 in mortgage interest. That's fantastic. Now, once again, you can pay your 30-year mortgage like a 15, and if you need the extra money, just don't make the extra payment that month. Make your regular 30-year payment. Doing any one of these things is going to help you save thousands of dollars on your mortgage. Take my advice, just put a little self-discipline in if you need, and just make those extra payments to your mortgage, and you're going to find that you're going to pay your mortgage off sooner, you're going to save a ton of money, and you're going to feel great when that mortgage is completely paid off. Now listen, if you have questions about buying or selling a home or mortgages or anything else for that matter, there's a fantastic resource you can use. It's my website. You can find me at www.MoveMeMark.com. Thanks so much for watching. If you missed our last episode, you can find it right here. And here's another episode that YouTube thinks you should watch. If you haven't subscribed yet, make sure you hit that circle and subscribe so you don't miss out. And I'll see you next week for more Monday Mornings with Mark. You have a great week.